Good day, fellow investors. Warren Buffett says, rule number one when it comes to investing, don't lose money. Let's check the current most looked at asset classes and see whether we can lose money there or not, what is the key risk, which is the essence of value investing, and then again, how to invest so that you don't lose money and compound forever. Now let's start by discussing the best strategy that worked over the last 16 years, and that was short fiat money and long whatever. Because if you look at Tesla, the stock is up 300 times over that exact period, but if you look at cumulative net income from Tesla over the 2 decades, whatever, it's 35 billion. If we look at the cumulative government-derived benefits, it's 18 to 30 billion. So practically Tesla made between 0 and 10 billion in profits over the years from real profits, but the market cap is 1.24 trillion. This is possible because everything, all the assets just went up like crazy. And that also means that being a value investor in this environment where everything goes up, no matter what the fundamentals are, is very, very hard. However, we have been enjoying 15 years of everything goes up, no matter what. What if the environment changes? Then we have to look at the risks. And the essence of value investing is low or no risk and high reward. When it comes to what to buy, you want to buy things and you want to say, oh my god, this is so cheap, I can't believe it is that cheap, I must have it at this price, this is crazy. That's the essence of value investing. I can't lose money on this, because you make your money, your profits already when you buy as cheap as it is. Just as a reference here, I want to do a little bit more fun videos here, so why don't you send me your portfolios for review from a value investing perspective at investwithsven@gmail.com. Also, if you join my platform, I'm happy to enter a discussion with you on your portfolio, and maybe I can give you my opinion, not tell you what to sell, but give you my opinion on the risk and reward. If you join my platform, you're sure in. So check also my platform, 21-day money-back guarantee. Now let's discuss the risks out there, and let's start with stocks. If we look at equity valuations, the US market is the most expensive, then we have Japan, Europe, emerging markets, and China, but 22 is the forward price to earnings ratio, emerging market 12, so a little bit cheaper. The question here is, can I lose money if I invest in the S&P 500? Of course you can't lose, because this will just go up forever like nothing will ever happen. I wish. But the thing is that with the current dividend yield of 1.17, the historical dividend of 4.2%, just if something happens and the dividend returns to normal, like it was for most of history, then the market would decline 73%, just to adjust to the mean historical, not the bottom historicals. And of course, the key assumption is that this time it's different. Stocks will just keep going up. The Fed will print money. Interest rates will be lower. Earnings will grow forever. AI will be so profitable. There will be never no competition. And we will all be rich as hell. That's it. If you like that assumption, well, enjoy life. See you never again, likely. If you don't like that assumption and you are more a friend of history and know that historically each time the market was on such exuberant valuations and levels, the next situation was 60+% real terms crash, then you are an intelligent person and you want to see what will work or not. Now, from the bottom of my heart, I hope that this time is different, the assumption that works, and that the markets don't crash, because that would lead to a lot of pain in humanity. I'm not here to say whether that's good or not, but let's just avoid it. However, when it comes to value investing, it's hard now when everything is high, but such a mentality allows you to buy when things are so cheap that you cannot believe those are that cheap. But then somebody would say, Sven, the market has been overvalued since 2015, and by not looking at it, you would have missed out on huge gains. That's correct, and the market did, what is this, a 4x over the last 10 years. Great returns, 14% per year. However, the key question here is, can I reach similar returns with much less risk? Because I want to avoid these situations, because whenever the markets are exuberant, history has shown us that the returns are bad. Now, speaking of Japan, who made a lot of money shorting that market by buying Japan puts when the market was expensive? Hedging is cheap, and Seth Klarman made a lot of money on that payoff. And if I look at the S&P 500 option chain, and if I look at, let's say I want to protect myself if it goes below 600 points for a year, a full year of expiration for the option. So it's just 21 the price on 600 for the SPY. That's just 3.5% of your portfolio. And then you cannot lose more than, what's that, 8% if the market goes below. If the market goes up, you just make money. So this hedge, because the people are so exuberant, is this incredibly cheap. It was usually 5%, now I see it as 3.5%, which is incredibly cheap to hedge. And then why not hedge the most expensive market in history? Look, everyone is long the US, so it might be smart to prevent historical situations to hedge. If I look at other markets, if I look at Europe, the P ratio is now above 15. This is the time to buy Europe when the P ratio is below 10. These are not the Nvidias, the Metas, the Amazons, the Googles of the world. So a P ratio of 15, 16 might be exuberant for European markets, but I'll be discussing a company on Monday, so subscribe and like for that. That has a P ratio of 11, dividend yield of 5, and this is actually an American company, but it is trading in Europe, and therefore it is cheap. This might be interesting. Emerging markets, first, 0.72 percentage points expense ratios, that's a lot. If we look at the portfolio characteristics, the yield is low, and they always buy the most expensive. So highest weight companies, Taiwan, Tencent, and if we just look at Taiwan Semiconductors, it's high. It's better to buy it when nobody likes it, not when everyone is exuberant about it. Can I lose money here? Yes, because these are not really great value margin of safety investments. One I can give you, CK Hutchinson from emerging markets. The market capitalization is 200 billion Hong Kong dollars. That's what, 25 billion US dollars. And they are in the process of selling 15% of their EBITDA for 20 billion of the ports, leaving 75% of Telecom Europe's retail Europe for much, much lower. And while you wait for the value to unlock there, you get a good yield. So if you want more investments like this, you can check my research platform, link in the description below, 21-day money-back guarantee, really to check the context also of this YouTube value investing focus channel and the strategy, really check my platform. Can we lose money with bonds? Now, I have to say something about bonds here that's very, very important. I think that bonds carry no risk now. Absolutely no risk. Bonds carry a 100% guarantee that you will lose all your money over the next few decades. Because in the 1970s, bonds were called certificates of confiscation because the inflation meant that what you would get back would be of zero value, and given the environment we are now, it will happen likely again. For 40 years, bonds did greatly because interest rates went just down. Now there was a little of a hiccup, but people again expect rates to go down. But if this happens, like it might happen given the fiscal situations out there, then I with bonds. And fortunately for bondholders, there is still so much demand. There is no dealer inventories, everything is great. But if this happens, like it was the case when markets were normal, then we'll see huge issues with refinancing, etc., etc. That is something scary. Also, look at the yields. You barely, if at all, beat inflation, which is crazy low. Therefore, you should be an idiot to have bonds in your portfolio. If you're not Warren Buffett, where you still get 4% in the US and then you know how to time the market to invest. So extremely risky if you can hold them from the short term. But if we look at pension funds, a significant part of those assets, especially US corporate pension funds and top European pension funds, have half of their pension in bonds, which means that if you have expectations to get some retirement funds from this, to retire with a mojito or a martini on some beach, well, start building a different pension, because this will not be worth much in purchasing power equals. If we just have a few more hits over the next decade, like we had here of inflation, then that's done. Also, if foreign people start selling US Treasury holdings, that might also be bad. Now, let's talk gold. Very hot topic here, but look at these peaks. I'm not looking at charts, but there are no fundamentals with gold, so we have to look at charts. These peaks have happened in the past. What was the result? Very ugly. And you don't have a dividend or something. Is gold diversification at all, or is just a gamble that central banks now are printing money to buy it? I don't know. I think it will do well, but there is always the question, can you do better? Similarly to gold, I think there is crypto, very in demand, especially with retail investors. And you can see here, everyone understands it's risky, but 65% of Gen Z plans to invest in crypto in the next 12 months. So the key driver there is, what if crypto really is the future? And second key driver is, look at the price, it's going up, it must be good. So you are basing your portfolio allocation, I'm assuming you're a serious investor here, on crypto where it's in the hands of Gen Zs? Okay, for now it has done greatly. I hope it just continues. I make money as people trade the ETFs and ups and downs. So good for me, good for them. When it comes to real estate, it's always about the deal first. If you go around in your area and you look at 1,000 real estate deals, I'm sure you'll find 10 good, I'm sure you can make 5 good offers, and I'm sure you can buy one piece of real estate that will be a great value investment. I'm sure about that. So there is always value there. But in general, if you can invest with a 30-year mortgage, thus you go short fiat currencies with a fixed rate for 30 years and can be called, if the real estate value fluctuates, that happens in the US, not in Europe, if you can buy it with a rent yield of 6%, likely in Europe, mortgages 30-year are still 4%, 3.7s, 4% in Germany, then you should do really well. At 6%, I was telling everybody to take a mortgage here, if you remember my videos. Now in the US it's a little bit different. Plus, given the jump in mortgage rates, house prices in the US should have fallen 30-40%. It didn't happen, which means that there is still so much gambling and speculating there. Which leads to the next position, everything is risk inflated, artificial interest rates that are low and money printing create this situation. It is what it is. We have to be patient and carefully watch for value investing, low risk, high reward opportunities. But the Fed is forced to lower rates. We'll see how that works. The European Central Bank is just printing money, now pausing a little bit, they will be printing again. Private equity is the biggest beneficiary of these low interest rates and money printing, because they can borrow at 3%, they can invest in 3%, and they can make money on what they think are capital gains. And you can see here, global infrastructure returns, the yield is actually around 3%, and then they say, oh, everything just goes up in value 5-7% per year, and we make a staggering 10% per year. This is how private equity and everyone works. As long as interest rates stay low, the bubble will continue. So if you're young, if you want to make a lot of money, go make private equity deals somewhere. But make sure you make the money before the market crashes. Then we have AI investments. What will be the real return on investment? There is question. What will be the real return for humanity? I'm working. I have now ChatGPT professional side. I think it's worth 5 analysts that I will not hire. I have one hire. Thank you, Misa, for editing. Don't worry, you won't lose your job. But I always thought I had to hire people. Now with AI, okay, I'm good. And because I can ask my employee, how many people should I hire to replace you when it comes to research? 4 to 6 people. 2 juniors, 2 mid-levels, 1 senior, 1 researcher, editor. So that's what, 6 people, that would be about 500K a year, likely most, and all of that I'm getting for 200 a month with ChatGPT. So this might remind us also of the internet, where investors that thought the internet will take over the world, which it actually did because you're watching me now on the internet, investor returns have not been great with these Verizon communications. Again, as long as interest rates stay low, inflation, hopefully interest rates will stay low. And this is perhaps the Ponzi scheme. The deficit is high, the government is borrowing 27% of the money it takes in, and most of that borrowing extra goes to pay interest, which is the definition of a Ponzi scheme. That debt, nearly a third, needs refinancing, which means there will be pressure on interest rates to refinance that debt. It's not that easy to lower interest rates. And you see here the interest payments are going up, doubled in the last 5 years, which is pretty significant. So you can print money, rig rates, and you can do that monetary policy solutions up to a point. As all pyramids, it works until it collapses and then it gets ugly. What is the solution? How not to lose money? Value investing, I've mentioned your hedge, which is something now those invested in the S&P 500 should strongly consider. Then you can invest into true asset values, P ratio of 10, good yields, profitable not just for now, defensive sectors, but you need to do the work. We have discussed 5 of those in the monthly quadrant video. Check that out. And one of that is food business, Amsterdam commodities, good yield, good P ratio, good growth, perhaps mid-position oil companies. That is something that is possible. But you need to do the work, and I think it's worth it to avoid these collapses. If you look at my model portfolio, it has a P ratio of 10 compared to the S&P 500 of 30. This chart is from my performance video that you can also check in the link in the description below. So I'm not fear-mongering, I'm fully invested, but I want simply to be ready for whatever happens. That's my investment philosophy. I don't want to invest on hopes, I want to be ready. I hope my being ready is completely futile and then people say, oh Sven, you did it for nothing. I hope for the good of humanity that it happens like that. But I sleep well as it is by being hedged, protected, doing good returns, value investments, and that's my style. If you like it, subscribe, check my other videos and my research platform.